Sorry about this, guys. First time I'm doing the .com. Trading room, and bit of a glitch there. Right, okay. You should be all able to see now the your questions and comments in the chat. Bienvenido, Ricardo. Thank you, Jose. Muchas gracias, Jose. Muchas gracias. Thank you. I'm half Spanish. I'm actually English. I'm British. I've got a British passport, but I've been 22 years living in Spain now. My name is Ricardo. My surname is down here, Sainz de Heredia, which is very Spanish. And then my second surname, my mother's surname, is Murray, from Scotland. She's from Scotland. I'm from London. As I say, I'm living here in Madrid. I'm a partner with Tony. Tony's off skiing, and we are actually going to start a second trading room for the .com site, which I'm going to be managing. I'll explain a bit about all this later. So up until now, I've been the last sort of few years managing, directing the optionelements.es site, which is the Spanish division in Spanish. I am a professional options trader. I manage my own money. I manage clients' money. I am a teacher and a mentor of all types of options trading. I've just written my first ebook as well in Spanish, sort of an introduction to options and basic strategies. I am actually the European representative and the South American representative for OptionView, the #1 software in the world. They're in Chicago. I'm sure you all know, or most of you know, the OptionView software. Tony uses it as well in in the trading rooms that he does with you guys, and to manage his own personal trading, etc. And I am considered really as a very totally multicultural person. Spanish, English, English, Spanish, totally bilingual, multicultural, you know. So without further ado, we'll get on with the presentation. Great, thanks for the SPX tip last night. Okay, right, great. Right, so basically what I was going to do, I was going to go over what we do in the Spanish trading room, which is basically what we're going to be doing in this in the second trading room in the .com site. So first of all, two different trading rooms, two different concepts, two different traders, two different people, two different persons, Tony and myself. Our trading styles are completely different. Our outlook on the market and on our trades is also very often pretty different as well. His style of trading, Tony's style of trading, is much more sort of speculative, short term. Mine's a bit longer term and less speculative, a bit more conservative. But that doesn't mean that we don't do a lot of speculative trading, weeklies and shorties trading in my trading room. What I'm saying with this is that the monthly trading we do with alerts is more conservative and sort of with a slightly longer time outlook on it than what Tony's strategies are doing with the alerts. In general, I do a lot. We do a lot more many strategies in my room. You'll see now more or less the types of strategies we're doing, and this brings me on to the different time zones. I'm here in Europe, 6 hours ahead of Tony, so the trading rooms the trading room times will be a bit earlier than Tony's. He was sort of catering for people in the UK, many English-speaking people in Europe, and possibly Asia as well. Different alerts. We have different trades, so we've got different alerts. We do different presentations, different courses, and the team here in Spain, I have a programmer, technicians guy who we sort of have our own in-house sets of algorithms and trading systems for what we're doing. His name is Angel, and we also have Patricia, who helps out on everything that we're doing here in Spain also. So, the strategies, which are the most important things. Hi Luke, you're based in Belgium, that's correct. We are on the same time zone as I am. Every week, just like Rick, you're welcome. We can do great, okay. Strategies. What I was going to do is first look at the monthly sort of strategies that we do. The monthly strategies are very similar to what the weirdo is. In fact, what I'm going to do is I'm going to show you the current monthly strategy. We actually cater for 3 different sizes of accounts. For a margin portfolio account, $100,000, Reg T account, $50,000, and a half Reg T account of $25,000. Now the current trade, the market's just closed now, the NDX is up about 7.19. We usually do the monthly, we nearly always do the monthly trades on the NDX. I'm going to get the margin portfolio account up, and this is the current trade. We scale in, we always scale in. We sort of scale in about 3 times, because these trades are often very short in Vega. We're nearly always short time premium. I mean, same as Tony, always long theta, but we're usually short Vega as well. In the end, because Vega and theta, it's all time premium, it's all sort of smoke that disappears in the end. All this time premium disappears in the end. Generally, we are on the real trades that we have on with the alert service. We are usually short Vega, short time premium. So this is actually the trade we got on at the moment. It's up about $974. We actually started this, I'll tell you now. See, it does look like a weirdo. Here we go. Started this back on the 19th of February. So today's the 5th of March. We've been there about 2 weeks. So this is the current trade we've got on. It's looking pretty good. The graph is looking good. The Greeks sort of delta 0, gamma minus 0.18. That's very flat. We've got a theta of $91 a day. And as I said before, because these options are a bit further out in time, the Vega is quite a bit negative, 686. So this is doing pretty well. Usually what we're looking for here is sort of from 2 to 3% for the month. If I go back to the presentation, you'll see that, there we go, the track record is really very good. In fact, last year we only had 1 losing month, which was October. You can see that here. We did lose in October, but that was the only month that we lost in. So sort of very conservative type of trading. We're trying to get a sort of between 2 and 3% each month, and there is a lot of time to adjust always. I understand that most people are working. Most people haven't got sort of time to be in front of the computer all day long watching the markets and watching the trades. So usually these strategies are very unstressful, and often in the month, well, there's really no adjusting to do at all. I mean, if we do have a good month like that, it's brilliant, because very stress-free. We make our money, we're out, and then we just look for the entrance on the next one. So, Donald, Ricardo, we were discussing NDX liquidity last week. How do you find the NDX? Yeah, the NDX liquidity, it is a bit worse than the Russell, but quite honestly, with this type of trading that I'm talking about now, the actual trades that we do on a monthly basis with the alerts, because there's so little adjustments to do, you know what, in the end, that slippage that we do, that sort of little bit of extra slippage that we suffer in getting into the trade and getting out of the trade and any sort of possible adjustments, as I say, there are really not that many adjustments to do. Quite honestly, it really doesn't affect us that much. I far prefer trading, I mean, the indexes rather than ETFs, of course, because on ETFs they are, you know, way less in value than the indexes, and then so we've got to pay an awful lot more in commissions. So yeah, there is a you know a slight problem there with liquidity, but usually if you're patient, if you try and adjust in sort of combo mode, in a combination strategy in trade to brokers or whichever broker you're with, you shouldn't really suffer that much, quite honestly. So John, Ricardo, from the 30th of November 2011 to the 30th, you seem to do 400%. Have you changed your method lately using a 3% on the gold? 30th of the 11th, November 11th to, let's see. No. This isn't the account size. These are just the winnings. These are just the winnings each. Sorry, hang on, let me just see what this is exactly. Hang on. This was prepared for me by our technician for the presentation today. These are just the accumulative winnings that we've had since 2002. I mean, the 30th of November 2011. So in the last 4 years, 4 months, on a margin portfolio account, we're up, what, 75%? Yep. Okay. Yeah, sorry, maybe I should have explained that. I'm sorry. So anyway, basically that's what we're doing with the monthly strategies. So they do come with the alerts. Much more conservative, time to adjust. We're looking for 2 to 3% on a monthly basis. And basically, I mean, it's not too difficult to be sort of achieving that without too much or so. We did have a bad time in October of last year, not because of the down market. I'll show you this. Interesting. It wasn't because of the down move it made in October. It was this up move that it made. We're already down sort of money here. We did our adjusting and things. It came all the way back, and we seemed to really never get our head above water, and it just kept going up and up and up. And possibly we could have cut our losses earlier. We didn't. Maybe that was, you know, one of the mistakes we made. But it wasn't because of the down move. It was because of the up move. The up move was so fast, so much, and the implied volatility really didn't go down as it should have gone down with such an upward moving tendency in the market. It's really what got us off guard and gave us the loss for October. Put back the presentation. Yeah, very similar to a weirdo. Very, very similar to a weirdo. Not exactly the same as a weirdo. As I said, we scale in. So that we to get into the trade, we do it sort of three times. So it's because we're so short implied volatility, we're so short Vega. We do try and pick moments when the market is falling and implied volatility is increasing, so as we get better prices when we're selling the Vega. Weekly strategy, that's very, very, very similar to what Tony's doing. Two different account sizes, margin portfolio and Reg T with the alerts, no adjustments, very, very similar to what Tony's doing. What we have incorporated in our trading room, and this soon now is going to be going live with alerts. And I think basically what's going to happen is going to substitute the trade that we've just seen before, the classical weeklies rut trade that you guys are also doing with Tony. This is a very, very similar type of strategy, but it's working wonders. We actually start a bit earlier. We start the day before. We've actually got a stop loss on this strategy as well, because the other one, the one that you guys are doing with Tony that we do, sort of from Fridays to Tuesdays, hasn't got a stop loss. This one has. And the extra day and the use of that stop loss, the back testing that we've got for this strategy since 2011, it's sort of the results nearly double the strategy that we're doing now with alerts on Friday, the strategy that Tony's doing with you guys and the one that I'm doing also. So the idea here is to substitute this new one, substitute the old one with this new strategy. That's sort of the idea. This is brilliant. This strategy really is incredible. It works brilliantly, really, 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 really well. In fact, lately we've been on a very, very good run. This is just going back to the weirder one again. This is the margin portfolio. I mean, we're sort of only using $55,000 of margin on the account. This is the Reg T trade. We're up $418. Again, very similar, sort of just half the size. And then this is the half Reg T. Yeah, so they're all looking good. I would have, I think, sort of on percentage terms, in fact, the smaller account, the half Reg T, is the one that's actually doing best. Here we're looking for $500 for the month, or $750, and it's already up 342. It's up already over 1%. So going back to this new strategy that we're doing on the weeklies, Russell, we started this one today, Wednesday. It's already up. The stop loss is determined on the cash flow, Jose. Stop loss is determined on the cash flow. This is the one that we opened today, a bit earlier this afternoon. It's already up. This is 20 contracts. This is a big account size. We always do this one on 20 contracts. And yeah, it's already up $1,600. And the track record of late is pretty incredible. This is the track record of late. These are just every weekend. So we've, I mean, if this week's a winner as well, it'll be 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 weeks in a row winning. We had a loss back here on the 10th week. This was a big loss here. But the track record, I mean, we were just, it's there on the presentation, is incredible. And as I say, we spent an enormous amount of time. Our technician guy here, we've even had subscribers of the training room joining in and helping out with the back testing and things. And the results, the track record of this strategy really does beat the other one hands down. It nearly doubles it. Nearly doubles it. And I'm not talking just about 1 year. I mean, this is back testing that we've done since 2011 for the last 4 years. And sort of every year, so 2011, 2012 were years of higher implied volatility in the market. And the strategy did really, really well. This type of strategy does work out better when implied volatility is higher, because those straddles that were selling are more expensive, and in general the position works out better. But 2013, 2014, where the implied volatility has been less, has also worked out really well. Rules for the new RUT weekly, entry to exit. Well, these haven't been exactly determined at the moment. As I say, we haven't gone live with this strategy for now. We've been testing it out. We want to be completely sure. We don't just do back testing. We got to do real-time testing as well with the subscribers. That's what we're doing in the trading room. We're seeing this happen every week. But when we actually do go live and we start with the alerts and things, will come out exactly with what the rules are. What would you say is the advantage of your strategy? You know what? You often hear that time premium for the weekend starts coming out on the Thursday. You know what? I think it starts coming out on the Wednesday. And you start these things a day earlier, and it's incredible. I'd say that is the advantage. But the time premium for the weekend starts coming out as early as Wednesday, quite honestly. The stop loss that we're using in terms of cash flow as well has, I mean, you don't often get a really big loss, but you can if you don't work on stop losses. If you do get sort of big gaps in the opening of the market, sort of near the weekend, either on the Friday or the Monday or something, and that's helped us out quite a lot as well. We also have different timings of entrance on the Wednesday as well, based on a very sort of complex algorithmic system, which seems to have helped us also. Very complicated to go into the details of that, but that also has seemed to given us a big advantage. So I'd say those three things. I'm very excited about this strategy. I think Tony is as well, from what I've been telling him about it. Then we have an account of $25,000, which we manage via the weeklies and shorties. Sorry, Rick, I didn't see adjust or just exit when it goes against you. Just exit, no adjustments. No adjustments at all. If it hits the stop on the cash flow, we're just out. That's it. We lose. No adjustments. Cool. Okay, Rick. Okay, so this account is an account where we're doing trades every week as well. It's we're just using weeklies and shorties options, 25,000K. So 25K, sorry, dollars, where basically we're using three different sets of trades, as I said, using weeklies and shorties. Basically, they are calendars, condors, and butterflies. They are all implemented on the indexes, NDX, SPX, and RUT. One of those trades is a trade that we do sort of. Sorry, I was saying to you. Sorry, I just realised now we don't go. Sorry, we don't go in on the Wednesday on the new trade. We go in on the Thursday. Sorry, I was sort of thinking that today was Wednesday. Today's Thursday. We go in on the Thursday instead of the Friday. I'm sorry. We don't go in on the Wednesday. We go in on the Thursday. And what I meant to say was at the time, you know, often people say, yeah, the time premium for the weekend starts coming out at the end of Thursday and Friday. I'm sorry. What I really meant to say is that I think the time premium for the weekend really does start coming out, yes, on the Wednesday, definitely already on Thursday morning. So you want to be in those trades already on the Thursday morning. Very sorry for that. I didn't mean Wednesday, I meant Thursday. Now, going back to this managed account of $25,000 dollars, we have a very similar trade to these other Russell weekend trades where we get in with an iron condor on Thursdays as well at 5:30. That's we always do that one. It's a calendar. It's a, sorry, a calendar. It's a condor trade on the RUT. Now the others, the butterflies and the calendars on the other indexes, on NDX and on SPX, they vary. They vary in accordance with levels of implied volatility, whether or not we pick a butterfly or whether or not we pick a calendar. And it also varies on what the index is, how they're sort of performing, what they're sort of doing, how they're moving, their statistical volatility as well, NDX and SPX. And then we also do earnings plays. Now, let me explain earnings plays. Because I'm the representative for OptionView. Just 1 second, please. Right. I have a new set of tools in my software which all relate to picking strategies for earnings announcements of US stocks. Now you can see here in my software, down here in the left-hand corner, are sort of 5 strategies: primes, E-primes, E-overs, E-pairs, echoes, and runners. They're the 5 strategies that OptionView bases its earnings plays on. They also have their own set of algorithmic trading systems that research the markets for the last 2 years, the last 8 earnings seasons. Usually companies release their earnings in January, April, July, and October. They're more or less when the majority of companies are announcing their earnings. Now, the first strategy is this one, E-primes. And you can see there by the text, these are stocks that make big moves. We buy a straddle on the day prior to announcement and sell it on the day of the announcement. Despite buying inflated volatility, these stocks have a history of making such big moves that the straddle usually pays off. The quality indicator is the expected return per trade. So what happens here is, I'm sure you all know, for example, here is sort of Canadian Solar before. It's on the 5th. It's today. They sort of announced today, I think. And I'm sure, yeah, they would have announced today because it's gone right up. Usually the implied volatility, which is the blue line here, you can't, it's not sort of that noticeable, but usually, I mean, in 95% of the cases when a company makes its earnings announcements, the implied volatility goes up, which makes the options very expensive because of the uncertainty that exists when a company is about to release its results. People don't know whether it's going to be really good or really bad, and what's going to happen with the shares of that company when they do actually release the results. So that could create uncertainty. Uncertainty creates implied volatility, and the implied volatility goes up. They become very expensive. So what happens with the primes is that even though they are that expensive, usually what happens is that they make the big moves that they make are worth buying the options, worth paying the money for that increased implied volatility, because the move they make is even bigger than what is sort of priced in the options for doing so. E-overs to these ones is completely the opposite. These are stocks that don't make a big enough move to justify the increased level of implied volatility in the options. So here you'd either start a calendar or sell a straddle the day prior to the announcement and close to the day of the announcement. Selling the inflated options pays off because the options tend to be overvalued apparently prior to the announcement. They don't move enough to justify the price of that straddle or strangle or whatever that you've sold. E-pairs, the third strategy. This is a strategy that involves two stocks, a primary stock that is making its announcements and a secondary stock that is a company in the same industry which tends to jump with the primary. What we're doing here is sort of piggybacking on a company that's got very expensive options because of the increased implied volatility. And what we're going to be doing is buying a straddle on the often non-inflated options of the secondary stock. Now, an example of this could be Visa and MasterCard. Say Visa's going to release their results for the day. What we do is buy a straddle in MasterCard. MasterCard, it isn't their day of releasing results, so usually their options aren't as expensive as Visa because of this. If the primary jumps, often the secondary will also jump. This is so if Visa does make a big move, usually MasterCard will move in the same direction, and it should be pretty big as well. And the quality indicator, again, is the expected return per trade. Echoes. The fourth strategy. This is a bit more complex. A strategy involves two stocks also in the same industry. If the primary stock announces and jumps more than 3%, either up or down, it makes a move of more than 3% either up or down, and the secondary stock announces 1 to 18 days after that, we take a position in that secondary stock prior to the announcement that will benefit from the stock moving in the same direction as the primary did. So if the, I don't know, say sort of Google and Baidu, say Google announces, makes a downward move of 5%, Baidu is announcing 10 days after. What we do is on the day of the announcement of Baidu, we'd implement a bearish trade, also trying to exploit the crush on implied volatility. We know the implied volatility is going down, so possibly what we may do is just sell a call spread at the money or something similar to that, and benefit from, in principle, the Baidu moving in the same direction as Google did 10 days earlier, and also benefiting from the falling implied volatility as soon as they release their results. It's a bit more difficult to explain, a bit more complex, but also works very well. And then runners, this is very simple. The thing is, we don't get many runners really, but they do come in from time to time. These are stocks that tend to run on announcement day. If the stock opens to the upside, go long for the rest of the day. If the stock opens down for the day, go short for until the end of until market close. Use whatever strategy you like, either bearish or bullish. The quality indicators, the stock's average percent move from the open to the close. As I say, all these strategies are all based on the last 2 years of earnings results, which is eight results in the last 2 years. And for each one, if we go to Amazon here, for example, they're releasing earnings on the 22nd of April. If I sort of right-click here, and this you'll get for every single strategy that OptionView is proposing to us. We've got the symbol, we've got the quality indicator, which means on average for the last 8 seasons, buying the straddle at the money straddle gives us a 29% profit. This is the volume of options for the underlying, and the past rate of success is 6 of 8, which means it's on the last 8 occasions it's won on 6. And this quality indicator is the average of the 8, which means that when it does lose, it really doesn't lose that much, and when it wins, it can win an awful lot. A lot of these, you'll find that sort of the past success rate is 3 of 8, so it's only won the last 3 times and lost the 5 and lost 5 of the last 8 times. Yet the quality is sort of, you know, plus 30 or plus 40 again. That means that it doesn't really lose that much when it does have a loss, and when it has the win, it wins an awful lot. And it always tells us here what to do: buy, straddle, or strangle about an hour prior to the close on the 22nd, and close the position anytime the following day. Although historically it has been profitable to hold until near the end of the day. So what we do with this account, what we do with this managed account of using the weeklies and shorties of $25,000 is to use these earnings plays. We sort of do it once every week. And this is the track record we have for this account. Then we have a varied monthly fortnight strategy. Now this is very similar to, I don't think, Tony isn't sort of in the market as much as I am, but when he is in the market, the sort of trade that he's doing with you guys, I think, is very similar to this. This is I'd say it's a speculative combination strategy trade where we're using weeklies and shorties again on the NDX. We've got a combination there of calendars, of diagonals, of vertical credit spreads. But there's one key to it all always, and we're looking for a flat T plus 0 line. Now I'll show you. No. Sorry. Right, there we go. Right. We're in the market basically the whole time. We got on these strategies, all these strategies that I'm talking to you all about there. We're basically doing them the whole time. Now, this is the current monthly fortnight strategy. It's up $533. I'm not joking. We haven't had a losing trade for a long time. We've been doing really well. And we haven't had a losing trade now for a long time. This trade basically always looks the same. We've got no upside risk, okay? No upside risk. You see the T plus. In fact, the T plus 0 line from a certain point just increases its profit. But the key here is we had a bit of a down day yesterday in the NDX. The NDX thing, this is a very small scale graph. I mean, since we started this trade, we have gone down a bit. We have got this big profit area down here. It depends how quickly we actually get down there to whether or not we'd be making money or not. But the thing is here, usually we're not usually sort of in this area. We're usually more in sort of in this area over here. And the key always is to have a very flat T plus 0 line. Now here we're very sort of delta, 0 delta. Often gamma, by having such a flat T plus 0, we often have gamma at 0, or we even have gamma at sort of plus something, with theta usually around 300, 200. We often have a positive gamma also, which is difficult to get, you know, when you're right. If you're long theta, you're going to be short gamma, or if you're short theta, you're going to be long gamma. It's very difficult to get them both positive. Well, we do, depending on the week or the month or the fortnight or whatever, what the market's doing, how the position is evolving, etc., etc. We often do see that, where we get a positive theta and a positive gamma. And we usually, here we are usually long Vega, just a little bit. This is usually a plus Vega trade. When did you open that NDX trade? John, I'll tell you. On the 2nd of March, so it was as I was saying here with the, it has gone down. I mean, since 2nd of March was sort of here. So we opened the trade up there, and since then it's sort of come down a bit. That's why we're in this sort of area down here. As I say, we're not usually in this area. We have this area there, but we're not usually there. We're usually sort of round here. And when that happens, if I click on the T+0 line and go here, you'll find there, if you look at my little box underneath my cursor there, in fact, this area, you've got to be careful because up here, theta at the moment is sort of over 300 because the market has moved down. It's moved down towards these short puts, which have increased in value. It's increased its time premium, and when time premium increases, which because of a falling market and increased implied volatility, it doesn't all go into the Vega. It also goes into the theta as well. Always time premium is shared between theta and Vega. And as you all know, theta is always more sensitive to options that get nearer the money, and this is what's happening. The underlying has been falling, and it is getting nearer these 10 puts that we sold that are now at a delta minus 10. I think when we sold them, sort of delta minus 5 or minus 4 or something like that. So what I'm trying to say here is that we usually find ourselves sort of in this part of the position. The only thing is, when we're in this part of the position, got to be very careful from each day to day. The Greeks can change because we're dealing with a pretty complex position on weeklies and shorties options. The Greeks can change very quickly from one day to the next, and often we can sort of have, you know, theta at plus 200, and then the market opens the next day and things, and sort of theta is at 0 or can even be negative. So we're always watching our T+0, T+1, T+2, T+3 lines, just making sure that we don't sink too much in what often the Americans call the sea of death on the position. But this is a position that we're not live on. We're not doing alerts or anything, but we're sort of testing it week by week. We've been several months doing it now, and I don't think we've had a loss. I don't think we've had a loss on this trade. It's doing really, really well, really, really well. So, well, this has gone back to the beginning. Right, this is another trade, the VXM plus 19. All right, the VXM plus 19 is a very infrequent trade. This doesn't often happen. We only get into this trade when the VXN is at 19. So, again, we haven't had a loss. Where's the VXN? Here we are. So what happens here is that our trigger for getting into the trade is just the implied volatility. And what happens is that I've got a line drawn here, horizontal line at 19. Now basically we're using this trib, I mean the level of 19 for current market conditions based on the last sort of 2 years. Lately, implied volatility has been higher, and we were thinking, well, in fact, the last time we got in wasn't at plus 19, it was up at plus 20, 23. We did change it for a while. I think because the implied volatility has fallen again to these sort of levels that we've been having in 2013, 2014. We're going to leave the trigger level again at 19. But here basically what happens is we get into a trade where we just use puts. There are no, but basically what we do is just sell put spreads really pretty way out of the money. Already the market's fallen quite a bit to get the VXN up to 19. What we do is sort of sell put spreads at sort of delta 6, delta 7. We protect them partially with 1 or 2 put debit spreads that we buy, and absolutely no calls are used. So we have no upside risk. So if the market does fall as the implied volatility goes up and then comes back, we don't care about any huge bullish moves because we haven't got any calls on this position. Our only worry is that the market continues falling and the implied volatility continues going up. But I must say also that when it gets up to 19, we only put on half a position. So basically, I mean, you know, this works out in 2013 only 4 times. As I said, it's a very infrequent trade. You've got to be patient, but it works out really, really well. 2013, we had 1 entrance, 2 entrances, 3 entrances, 4 entrances, 5 entrances. Sorry, I've gone into 2014. 2013, we had 1, yeah, just 2 entrances. 2014, 1, 2, 3. No, hang on, no. 2013, we had more entrances. The thing is, like, we haven't. As I say, this is a trade. The level of the VXN for triggering the trade can change depending on current market conditions and implied volatility levels. But this is 2013. So 2013 we had 1 entrance, 2 entrances, 3 entrances, 4 entrances, 4 trades. 2014 we've had 1, 2, 3, 4. This was the worst trade we've had. But we actually never got up to a level where we had to put on the second part of the trade. We only, as I said, we start with half a position, and we never actually got up to a level where we put the second half of the position up. I mean, we did incur sort of, you know, losses at the beginning, but it was sort of just for 2 or 3 days because it's the implied volatility came down all the way as well. You guys know that implied volatility is all part of time premium, and time premium just vanishes as time goes by. Vega becomes less sensitive as the options get nearer their expiry date, and volatility always reverts to the mean. The thing is, you don't always know when. It doesn't always come down as quick as what we're seeing in 2013 and 2014. If we go back to other years when there's been more implied volatility in the market, sometimes if the levels are kept up there, we're going to have to be longer in the trade. But in the end, it goes away. The only options that are worth any money when they expire are the ones that are in the money. And 95% of options that are traded, and the trading that we do, that Tony does, etc., are options that are out of the money. So what we're doing is just trading with extrinsic time value. And let me answer the question. Rick, wouldn't you reduce your margin by adding a long call against the short strike on the back week? You could. Are you talking about the trade before, Rick? Adding a long call against the short strike on the back week. Yes. I mean, basically, for that, sorry, I didn't see the question when I was on this. I mean, we work in spreads here. There's no naked options being sold. Wouldn't you reduce your margin by adding a long call against a short strike on the back week? Yeah, that's not a bad. Yeah, you're right. Yeah. I mean, basically, you know, what's covering this call here is this call here in the second series of the weeklies, and I mean, you know, this does act very well as for covering margins. But yeah, possibly that's not a bad assumption. Short strike pair with a cheap call. Yeah, no, definitely. But as I say, I mean, there are in this trade only in the monthly margin portfolio trade we sell naked options, and it's only the calls. We don't sell any naked puts ever. Just naked calls in the margin portfolio account. And on the weeklies in the Russell, so those big accounts, we're just selling straddles. On the smaller accounts, we have to do it via iron condors. But yeah, definitely. But I mean, don't undermine these weekly options for reducing margin. They work really well in reducing margin as well. I mean, quite honestly, what this is this is sort of just a short diagonal, isn't it? Really, that's what this trade is. And here, this is a combination of 6 long diagonals and 4 short credit spreads on the puts. Sorry, I didn't see the question before. So back to the VXN 19. I mean, basically, I'll show you quickly what it looks like when we start off with strategy. Where is it here? The last time we started was on the 2nd of February at 4:30. That was when it hit 23. We put the level up at 23, so we still call it the VXN 19. Right, so I said the 2nd of the 2nd, 2015. 16:30. Right, so see what happened this day. Let's go to the VXN. 22.99. It did hit. It was over. It did get to 23.37. Okay, 23.37. So we've got this horizontal line here also at sort of the 23 level. And the thing is that our assumption at this time was that market conditions were changing and that we were going to start getting into an environment of, you know, higher implied volatility, sort of like 2011, 2012. In the end, it looks like this is not going to happen. In the end, it looks like that we're going to continue with low implied volatility for now. So the trigger will go back again to 19. But at this time, we had put the trigger up at 23, and the position looks like this. You know, it's a medium-term trade. The options that we're using were 46 days out. We've got time there, the time to, you know, for the market to sort of recover a bit, for time to pass, and basically that's the trade. The way, as I say, it's sort of half of we only put on a half position at this time, because obviously implied volatility may continue going up, the market may continue falling, and in the end, the way after that, the way in which we adjust the position is through sort of these gears, which are formed by the long put spread that we bought. sort of halfway between, you know, where, no, a bit more than halfway between where, you know, where the money is and the 9 put spreads that are sold. As I said, it's delta 7. That's when that's the delta, the short strike of the puts, and the price chart of yeah, we sort of based the it's, you know, it hit a support that day. In the end, what's happened is just gone up again, which happens many times. So I don't really use that much technical analysis at all. I just have a few tendency lines in the graph, and supports and resistance. That's basically it. And I always say the same. I mean, sort of 70–80% of the time, anytime you hit a support to a resistance, it's always going to go back, because you don't know when it's not going to happen, and when you're going to get the times when it's like, you know, the 20 or 30% when it does break the resistance or break the support. But I mean, you know, those are the probabilities. Sort of 70% every time it touches a support to a resistance, it's gonna sort of bounce back. That's sort of my technical analysis. Okay, so no upside risk, and this was a winner again. All of them have been winners. So that's the VXN, as I say, but this doesn't, I mean, you know, happens 4 times a year or something. You've got to be a bit patient with this. It keeps your line flat, yeah. So it's like March the 15th. Donald, sorry, Ricardo, when do you send out most of your calls in EST time? Well, I mean, you know, if I suppose you mean the alerts. The alerts, the calls, you know, for those monthly positions, if you do need to adjust because of market movements, it could be any time. I mean, you know that. We don't know whether the market's going to make its big move sort of the first thing in the morning in the States, or just before it closes or whatever. So in that sense, you know, it could be any time. But usually I'd say 90% of the time, we're talking about 5 or 6 o'clock in the afternoon, 5, 6, 7. So more 5, 6 o'clock in the afternoon. Bodan, sounds like you really trade this stuff. No, we do. My life is, you know, completely dominated by options trading. So yeah. And no, I mean, our subscribers and things, you know, they love it, and we learn an awful lot, and it's great. We got a big lunch in Madrid here on Saturday. All the subscribers here in a hotel in Madrid. We're going to be meeting up personally. People are coming from sort of Seville and Barcelona and things. So it'll be good. Rick, this is with respect to the call, though, wouldn't you reduce your margin? Okay, got that. I think I've answered all the comments and questions. Please, if I've missed something, if you could please put it back there, and I'm sorry. We're nearly finished. So this is the VXN, no calls, no upside risk, less frequent trade, okay. Or on volatility. We do an alpha 2 trade. This is a trade that is, again, a longer term trade, flat T plus 0 line. I don't like this trade too much. We got subscribers in the room that do like it, so we do it, but I don't really like it too much. Just doesn't seem to work out. It's sort of good for selling courses and things, and for doing webinars, but in the end, in reality, it doesn't really work out. Basically, we're talking about bearish butterflies and a deep in the money call. We've got one on now, and it's basically not doing anything as usual. You don't really lose, but you don't really win. That's sort of my experience of this trade. I don't know if anyone wants to correct me on this. You know, it looks good on paper, but it never really seems to work out. I mean, you know, we've been in this trade now for, it says we're up $164. Again, the key is to have the T plus 0 line very flat, but with 43 days out. This is a different sort of trade than the one we were looking at before. And this trade we started on the 25th of February. So we sort of, you know, last week we started this, and this is the result. We haven't made any adjustments yet. We haven't needed to make any adjustments. The Russell has been very sort of lateral. But surprisingly enough, it's been that lateral, and this trade is not making more money. That's the surprising thing. So, Donald says 6 p.m. Madrid time, yeah, Central European time, yes, Madrid time. So, Donald, I don't know, have you said where you are? I mean, if you're in the UK, that would be 5 o'clock. But I mean, Madrid time is the same as Paris, Belgium. You know, I don't know where. Oh, you're in New Zealand. Well, in New Zealand. Wow. Okay. So, right. Well, I've been a lot to Australia. I haven't been to New Zealand ever. I love Australia. Auckland. My brothers have been loads to Auckland. They love it. They always speak so well of New Zealand and Auckland. So you're what? You're sort of 12 hours, 11 hours. There. What is it? 20 past 10 in the morning, is it, or? Wow. Well, it's nice to have you here. My younger brother, he's married to a lovely Australian girl. But I used to go a lot to Australia. I've been to Canberra and Sydney and many cities there. Yeah, I know. I've been told that New Zealand's better than the Aussie. I know. 11:21. Okay, so exactly. Well, here it's 11:21 at night, so you're exactly 12 hours ahead the next day. Okay. All right. Thank you, Donald. And basically that's it. Those are the trades we're doing. We also look at other things. Okay. We look at gamma scalping. We look at arbitrage. We look at intraday strategies, sort of starting them, you know, as soon as the market opens and finishing before it closes. We look at live trade executions as well. The whole problem of slippage and everything else that I was asked about earlier in the trading room session. We look at this. I've actually done a little course, recorded course for executions, because people do have a lot of problems with this. I understand it. And the use of option view, of course. I am the representative, so we do that as well. I'm starting this up now at Capital Discussions. I mean, Tom Nunamaker helps us out an awful lot on all of this. He's at Capital Discussions. I'm starting sort of in 10 days' time or so premium alert service with them. Basically, they're very short-term strategies, very similar to what we're doing at Option Elements, but these are just alert services. And basically, they're all alerts that they've got the earnings plays and things, you know, just for one night or over, you know, trade sort of over the weekend for a few days, and then there's a volatility trade there. Also, I just wanted to mention that we do all the work, you just follow the alert. But this is Capital Discussions. And my thank you to you all. I don't know exactly when I'm going to be starting this second trading room at optionelements.com. Tom has enabled the member site for me. I think that was done today. What we're going to do is we're going to upload. I've got to translate all the stuff. My problem is that everything I've got is in Spanish. You know, everything that I've been teaching in options and mentoring, everything else is in Spanish. I've now got to start doing everything in English as well. And so I've got a lot of translating to do. So I've got to translate sort of the last 2 months of our trades and everything, get them onto the member site at your site, at the .com site, so as people, you know, can go back and see exactly what we've been doing, and then just, you know, start the ball rolling. As I said, the times are going to be different. They're going to be earlier. They're not going to be, you know, I'm not going to be up. I get up at 6 o'clock every morning already. I'm not going to be up at sort of this time every day giving webinars and sessions, quite honestly, is too much for me. So the idea of all this is to do the trading sessions earlier in the day, and we're also sort of thinking about English-speaking people in Asia as well. And I don't know, Donald, maybe people like you guys who are in even further away. I don't know if an earlier session would be better for you or not. I really don't know. But sort of these are the lines of thinking we have on the way in which we're going to structure this the number 2 trading room. Tony will obviously continue with his trading room number 1 and me trading room number 2. So thank you all. Rick, Capital Discussion says it's coming. Yeah, it's coming. I think next week I'm presenting that. Jose optionelements.es. Yeah, that's. Yeah, I don't know if you guys have seen the website in Spanish. There it is. There it is, all in Spanish. That's me. These are all the courses and things. I do a lot of television stuff I do a lot of videos, sort of interviews and things at the Spanish Stock Exchange for magazines and websites and things. I just got to start getting used to doing it all in English now as well. I actually find it's weird for me to teach in English and to present in English. It is my mother tongue, the same as Spanish, but I've always sort of done all this in Spanish. So I don't know. I need a few days sort of to get into the jive of this, I think. Ricardo, please put your contact info into the chat room. Yes, of course. Well, I'll give you this. It's very simple. Ricardo at optionelements.com. .com, not for the email. It's well, that should be in small letters. Sorry. But there we go. Ricardo at optionelements.com. Same as Tony at optionelements.com, or Tom at optionelements.com. And then we've got Angel, who's working with me here, Patricia as well, everyone at optionelements.com. And I'm just seeing if I've missed any questions here. How did I meet Tony? Oh, we met on internet. I don't know how. Can't remember now because it's sort of 5 years ago. But I've been with Tony. Our families, we've been together in Florida, in Miami. We had a great time together, his family and my family and things. I have, my wife, and I have a son of 6 years old and a baby daughter of 20 months. And I live in the northern part of Madrid. I've got a brother who lives down in the south in Marbella, which is all sort of sunny and nice. Better weather than here in Madrid. But I've known Tony a long time now. He's a great guy. Tony, we're really good friends, and we're doing this joint venture, Option Elements and things, and it's brilliant. And Tom is as well. Rick, can't click on your site yet, Ricardo. Okay, well, it should be working. It's optionelements.es. Should be working. I think there's a link from the .com site. It says Español, Spanish, and you can sort of get onto the to our site from there. Ricardo, okay, thank you, Bodan. I guess PX should still be a good one again. Okay, thank you. That was such a easy options. Yeah, saw one of those. Man, the Spanish is spoken so fast. Yeah, I'm actually, the thing is, because I live in Spain, I suppose I'm speaking Spanish sort of 70–75% of the time, and I speak English maybe only 20–25%. So in general, I think Spaniards do speak their language quicker than English-speaking people. Greg, yes, premium better than right. Thanks. Right. Okay. Well. Okay. 11:30. Thank you to all of you for attending the the trading room session tonight. Tony will be back on Tuesday, and it's been delightful for me, a great opportunity, very happy, and I hope to be seeing you all in the future also. So thank you very much, and good night, and have a great rest of the day to all of you guys that are still in the afternoon. Thank you very much to you all. Thank you. Thank you. Bye-bye.